If I see one more $10,000 per month passive income course that's actually teaching you how to build a business that's taxed at closer to 50%, I'm going to lose it. Here's the truth. 99% of the people using the term passive income are using it wrong, and it's costing them a massive amount in taxes. The IRS has very specific definitions for different types of income, and when you understand them, you can literally cut your tax bill by tens of thousands of dollars. So what if I told you that real passive income can be taxed at closer to 0%, while that passive course income that everyone's talking about gets hit at closer to 50%? Stick around because I'm about to break down the 3 types of income that actually matter for building wealth. Hello, I'm Christopher Nelson. I built and run my own microfamily office and teach others how to do the same thing. I used to make the same mistake. I would call all the income that came from my portfolio passive income. But then this term continued to get overused, misapplied, that I realized that if I really wanted to teach and educate you, I had to get more precise. Because here's what happened. I was lumping together all types of income streams that the IRS treats very differently. And in my perception, in what I was allocating time and effort to, it was costing me money and also strategic clarity. So today, I want to give you my framework of what I use to categorize income properly. I want to cover off on the 3 types of income that matter for wealth building, for managing tech millions. I want to dial in on how the IRS taxes each one, talking about ranges. Everyone's situation is going to be different, but it's important that you have a range and a marker, and why precision in terminology can save you thousands when you're strategically focused on the right things. And then all of this leads to, how do you structure your portfolio for the maximum tax efficiency? My goal is to give you the clarity to make better investment decisions and stop falling for passive income marketing that's really just a high tax business income in disguise. So let's start with why this matters. If you open YouTube, Instagram, or any finance blog, you're going to see passive income attached to everything. YouTube ads equal passive income. Drop shipping business, passive income. Real estate, passive income. That's the problem, because the reality is the IRS doesn't care what you call it. They have very specific definitions, and those definitions determine how much tax you pay. When I first got into investing and managing my portfolio as a business, I was calling everything passive income. But then I started learning that my rental property income, my private equity income was being offset by depreciation, while income from dividends or income from interest or income from my coaching was getting hammered at a lot of different tax rates. So this is when I realized not all passive income is created equal. In fact, the majority of what people call passive income is not passive income at all, according to the IRS. So I developed a simple framework to categorize income properly. 3 types that matter for wealth building, for managing your money, that each have very different tax implications. Let me show you exactly how this works. Here are the 3 categories that actually matter the most for wealth building. Let's start with number 1, passive income, the real deal. So according to the IRS, passive income comes from rental real estate in businesses in which you don't materially participate. And here's the key. If you don't materially participate in these businesses, it comes with special tax advantages. So passive income is typically taxed at capital gains rate, 0 to 20%. That's a nice tax rate. But here's where it gets really powerful, is you can deduct the depreciation of your real estate, of your business assets, machinery, computers, anything that's depreciable against your passive income. and sometimes even against your other active income as well in special situations. So, for example, you own a rental property generating $50,000 a year. The depreciation deduction on that same asset might be $40,000. So you only pay taxes on the $10,000. And if that's at a tax rate of 20%, that's $2,000. So you've received $50,000 in income in cash flow, and you only pay $2,000 in taxes. That is incredibly powerful. And it's that type of investing that can replace your paycheck. Now, there's even additional values here too, because 1031 exchanges allow you to take fully appreciated assets, roll them into other like kind assets, and defer taxes indefinitely. And when you die, if you're doing this right and you're thinking about generational wealth, your heirs can get stepped up basis, meaning higher value of assets, but capital gains has been eliminated by your passing. This is why real passive income, how the IRS defines it, is special. It's not about work. It's truly about the tax treatment and getting this high value yield into your portfolio. Number two is portfolio income. Your portfolio income comes from your financial investments, stocks, bonds, REITs, and any other type of private equity that does not qualify as passive income, does not have that magic depreciation component, because all of those types of investments are going to have different types of tax treatments. You will have qualified dividends that are coming from certain investments. Those will qualify for 0 to 20%, a nice capital gains rate. You can also have your interest income that's taxed at 10 to 37%, an ordinary income tax rate. REIT distributions taxed as ordinary income. The key thing to understand is from your portfolio income, you're not going to have the depreciation benefits that comes from the passive income. What you earn is also going to have a higher tax rate. So let's use the example of the REIT. The REIT, you get $50,000 of income from a particular REIT investment, but if it's taxed at ordinary rates, that could be as much as $18,500 in taxes, right? This is very different in what you're actually going to have flow to your bottom line. When you compare portfolio income from passive income, it's different in the sense that you can have phenomenal investments that are continuing to grow, but it's going to be taxed as a higher rate. So that's going to be qualified as portfolio income. Okay, number three is your business income, active creation. This is where most passive income gurus are actually operating. This is business income that's coming from coaching, courses, YouTube channels, affiliate marketing, drop shipping, anything else that you actively create or manage. This is the tax bracket that gets hit the hardest. It could get hit with ordinary income rates, so that's 10 to 37%, or it could also have a self-employment tax on top of it. You may also be hit with state taxes up to another 13%, depending on your state. The key thing to understand is many of these are also going to be run as businesses and have some operating expenses to go against the revenue. But ultimately, if you have a $50,000 course that everyone's calling passive income, in California, if you generate $50,000, you have very lean margins, you can pay over $26,000 in taxes. That's a 52% effective tax rate. This is where I just want to be honest and talk about the truth. Like, this is not passive income and how the IRS defines it. It's truly business income, and the IRS taxes it exactly like a business. So now that you have these three, true passive income, portfolio income, and business income, let me show you side by side why precision matters, why these definitions and these words really mean something. Okay, I want to now line these up and show you that when you compare the taxes against these, this is going to change your complete perception and get you focused in on what is true passive income. So for this exercise, let's take the same $50,000 of income and see how much you actually keep under each category. So, true passive income, right? We are investing in some private equity real estate. Gross income from that investment, the income we receive is $50,000. The depreciation deduction is $40,000. Taxable income is 10, and we're in the 20% tax bracket, which is $2,000. Net income, $48,000. Beautiful. We made $50,000. We have in our bank account $48,000. Now, let's compare this against real estate in the public market, a portfolio income coming from a REIT, gross income of $50,000, $50,000 of taxable income, but we're going to tax that as a 37% ordinary income rate. That's $18,500 of taxes, and you're taking home $31,500. Now let's go to $50,000 of business income. This is from coaching sales. So you generate $50,000. You then have a self-employment tax of $7,650, and you have the 37% bracket, your income bracket, that's $18,500. You're walking home with $23,850. So this is exactly my point. The same $50,000, but when you look at these categories of income, passive income, $48,000 take home, that's 96% of that gross revenue you're taking home. Portfolio income, you're taking home 63% of it, or $31,500. But what everybody calls passive income really isn't. It's business income, and you're taking home 48% of that at $23,850. So this is why these gurus that are talking about passive income and reusing that term are doing you a disservice. They're really calling business income passive when it's taxed at literally double the rate of true, real passive income. So what's important for you, for my money managers that are managing tech millions? If you understand these differences, then you structure your wealth building to prioritize the most tax efficient income streams first. This is what's going to give you the best benefit. Now, let me explain why these words and why being precise with them matters when it comes to wealth building and architecting your microfamily office. Let's start with, what is the order of prioritizing these different types of income that are the best for smart wealth building? Number one, maximize passive income first, right? This is your real estate and private equity that comes with depreciation and meets the IRS requirement, because you're getting high income and you're getting it very tax efficiently. The second priority is then going to be portfolio income. You can actually keep investments growing. You don't even need to make them taxable immediately, but that is your diversified investments that have a better tax treatment than business income, but not as great as passive income. Number three is scale business income strategically, right? Know the tax cost of your business income and prioritize passive income and portfolio income first. So when I restructured my microfamily office, I prioritized my private equity investments, real estate investments that could generate passive income complemented with depreciation benefits. I was then diversifying and growing my stock portfolio, bond portfolio, and other investments that didn't have as beneficial tax treatment. This is what allowed me to truly replace my paycheck. Now, the business income coming in from coaching and courses, that's funding the first two categories. I continue to take any type of income I get from my businesses, and I buy more of these assets that are going to generate true passive income. Today, 95% of my paycheck replacement is coming from passive income investments that are tax-free, or the tax is being deferred, while I use the higher tax business income to buy more of these investments. This is an important strategy call out, is that I am architecting and building my microfamily office to generate, not just for my generation, but for the next, tax efficient passive income. The challenge is that many people chase this highest gross return, but they don't consider the after tax returns. A 6% passive income return might be a 10% business income return after taxes. You have to do the math. So here's the framework, right? Passive income, that builds your foundation. Lowest taxes, highest amount of income, that is going to be your stable, your foundational level. Then you have your portfolio income, providing diversification and liquidity. Then you stack onto that your business income that accelerates wealth building by buying more of the passive income. It gets reinvested into the other two. This is how you build generational wealth instead of just high tax income streams. So here's how you take this framework and you start putting it into practice. First and foremost, audit the current income that is coming from your microfamily office, from all your sources of income, right? And then you want to categorize them. What do you have that's truly passive income with tax benefits? Call that out and set that aside. Then what is your portfolio income that you're getting from your investments? Do you have business income that you're calling passive that's really not? Allocate that appropriately. And then for many of you, you're going to have W-2 income as well. And then you're also going to have income coming from your equity compensation. Categorize those appropriately. Now, calculate your real after-tax returns on each of those different types of investments. Don't just look at gross returns. Make sure that you get real with yourself and understand what is the tax rate for each income type. Where are depreciation benefits available that you can use? Do you also need to make sure that you're applying self-employment taxes for business income if you're doing some consulting or you do have a side hustle? And the key thing is to rebalance your strategy based on your analysis. How do you prioritize building true passive income and generating paycheck replacement income that is tax protected, right? How do you then diversify with portfolio investments for liquidity and better tax treatment? Then ultimately, how do you use, whether it's your business income or it's your equity compensation, to fund these other two categories so that you're building strategically your microfamily office, right? For you as tech professionals, right, your high W-2 income automatically puts you in a top tax bracket. But you can actually leverage passive income to get out of there by continuing to invest in assets that generate income that's tax protected, because sometimes you only need $175,000 in tax protected income to replace $250,000 in W-2 income. The reality is that if you're generating significant business income, you can also really think about how do you structure it through your family office and different entities that can continue to invest in passive income opportunities, that you're converting high tax business income into lower tax passive income over time. This is how you play to win. Here's what you need to do right now. First, stop calling everything passive income. Use the proper terminology. Passive income for real estate and private equity that has depreciation benefits where you're not actively involved in the business. Portfolio income is for all of your other financial market and private equity investments that don't have depreciation associated with it. Then you have your business income, anything you actively create or manage. And then in addition to that, you have your W-2 income, anything you earn as a wage. Run the math on your current income streams. You might discover that some of your highest performing investments are actually underperforming when it comes to taking home the dollars. Re-architect and structure your wealth building to maximize passive income first. This is the foundational way of every microfamily office that I work with. Is how do you flip the script and focus 100% on tax protected income? The precision in terminology and tax strategy is what we've built into Wealth Ops framework. Wealth Ops is not just about making money, it's about managing it and keeping more of it so that it's structured for long-term wealth for multiple generations. The reality is the difference between a 48% tax rate and a 4% tax rate on the same income amount is not just math. It's the difference between actually building wealth and staying on the income treadmill. If this level of precision and strategy resonates with you, hit subscribe right now because I'm going to continue making videos that are breaking down more advanced wealth management concepts specifically for high earning tech professionals who work for equity income. And if you really want to build generational wealth and you want to understand deeper of how to structure your portfolio like a business, I would encourage you to think about attending our monthly live event. Go to wealthops.live. And I think the final takeaway is remember, words matter, taxes matter more. And the precision in both is going to determine whether you build wealth or just generate taxable income.